So she's still with us. She hasn't left the room yet. Part 3 of our series with Stephanie Leak. This week, we're going to talk about just some general investing lessons that we all can take to heart that Stephanie's going to share with us to help us all become better investors. We've touched on these, but I wanted to get into lessons and really some things that maybe I've tried to impart, but would love for you to tackle them, of just lessons. So if you're ready, this will be a little bit to use speaker used to, the lightning rounds. Number one, walk through, again, I think for a lot of investors, sentiment and expectations versus absolutes, right? And how less bad can be better for a stock than good. How do you think through that in your own portfolio? How would you explain that to someone, just again, in terms of how markets work, how stocks work, that it isn't just the dollars in the door, although that's important, but again, expectations and how you judge that?
Oh, sure. And sentiment, you mentioned it, it's spot on. I mean, that is what a lot of, at least timing factors, it really is important. We were talking earlier that I've never, rarely made money when I am on the same side of the boat as everybody else. I usually make money when it's a little controversial or just a little less popular, if you will. I also look on the sentiment, the analysts that cover these stocks on what we call the sell side, they cover these companies, they make recommendations, they write reports, and that people like me who's running money, the buy side, I read these reports and then I make a decision as to what I want to do. When the sell side, when the analysts all like a stock, who's left to upgrade it, right? And who is left to buy it? And so we've seen a lot of concentration in the last 2 years in the marketplace, year and a half. That will run its course eventually. And valuations do matter. So I think that's a really important lesson. I try to be a little bit different. I try to find themes, because I have a lot of different themes that I'm really positive on. I try to find themes, and then I try to find maybe the less popular companies within those themes. I look at laggards a lot. So if, let's call it, cybersecurity is an example. Well, you can own the very best one that's done the best. I tend to look at, if it's a fresh look, I try to find the one that's maybe not done as well, maybe has lagged a little bit, but can play catch up because that big theme is important to me. But that's a really big part of investing. And some people are very comfortable being momentum investors, kind of chasing stocks higher and higher. I'm not so much. Yeah. I like being a little bit like contrarian and a little bit less off the radar. Have
you read the book, Matt's tired of me here talking about this, The Psychology of Money?
Yes, I have.
Great book. But I thought it was interesting, his part talking about, people aren't crazy. I get the point he's making. I might disagree with part of that. But just how to the, let's just say, average investor, they might look at it and say, well, the stock's going up, so that must mean things are good.
Yeah.
When in fact, it may just be that the buyers of that moment are momentum traders, and they're not deep value, and their time horizon isn't 10 years for their retirement, it's 10 minutes on a trade. Right. And to be careful about not confusing, again, what you might be seeing on the surface and the rationale for why that's occurring.
We talked a little bit about, I start off with macro. Why do I start off with macro? Because you got to get the macro right so that you can see what the underlying growth is happening in the economy. And if you have above average growth in the economy, you will have above average growth in earnings. That actually is what stocks pay attention to. That's what investors pay attention to. Stocks follow profits. My good friend Larry Kudlow told me that 16 years ago. And it's true, on the way up and on the way down. Maybe the momentum stocks do well for a time being because earnings are going up substantially. But once that turns, that's tough. It can really be a challenge.
Well, we probably don't have time to get in it today, but I know a lot of times when valuations disconnect to those earnings, the popular narrative is like, well, earnings will catch up.
Yeah.
When, again, I don't know, have a hard stat to do this, more times than not, it seems like those valuations come down. They will follow earnings higher, but the idea of this magical narrative suspending economic market gravity rarely plays out.
Exactly.
Second question, How do you think about regret when it comes to investing? I think everyone's got coulda, woulda, shouldas, could be a single stock that they would have bought. I think for a lot of people, it's, the most recent example would be COVID. For some people, especially, and we won't get into politics, my party didn't win this year, and so now I'm giving up hope for the world. But however it manifests, how do you think about regret? And how do you avoid it?
Oh, it's hard. That's what makes this business so humbling. I learned a long time ago, invest in what you know. And the great Peter Lynch is the one that actually taught all of us. He would watch, look, observe, what were people eating, what were people wearing, what were people using in terms of technology, all those kinds of things. And then he would try to figure out, okay, well, does it make sense? Then you do the analysis, right? You do the fundamental analysis to see if it makes sense to invest in that sort of thing. I have learned that when I have tried to own something that I don't exactly understand the whole business model, that's dangerous. Second thing is it's really hard to sell stocks. Like, you can be up, and I was up in a couple of the Mag 7, 100, 200, 300%, and I sold some, and they kept on going higher. But one thing that I have learned also is never apologize for a profit. It could turn in a dime, and it could have reversed. It could keep going higher, or it can turn down. So to me, if I make money and I feel like the story has played itself out, I will sell, or I'll trim along the way. And sometimes I don't catch the top. It's much easier for me to buy low, and I try to sell high. Most people say they do that, by the way. Most people don't. Most people buy high and sell low.
I did a commentary a few weeks ago. It was like, you're probably buying low if it feels stupid.
Yeah, absolutely, 100%.
I mean, if you struggle to justify, again, being a little facetious here, what you're doing and why you're doing it, more times than not, it's right. If it feels too easy, if the newspaper can give you 100 reasons why it's a smart idea, it's probably tired.
Yeah.
How do you differentiate opportunity from, as the old industry adage goes, catching a falling knife, right?
Yeah.
And we talked about how valuation isn't a catalyst. So you can be, hey, it's a great company, great price, but maybe it's not going to be a great stock within the time frame that you would hope to have.
So when a stock is going down and it keeps going down on the same news, you know that it has probably more room to go down. When a stock actually goes up on bad news, like a company cuts the dividend, but the stock's already down 20% on people fearing that they're going to cut the dividend, they cut the dividend and then the stock actually rallies.
Just to rephrase that, because that's an interesting point. The stock keeps going down on the same news, that's a red flag to you.
To me, absolutely. Because you're trying to time it in a way. I mean, you could do all the fundamental analysis and you can come up with, this is a really cheap stock, and the cash flow and the free cash flow yield and all this other stuff, you can come through and it still goes down every single day on the same piece of information. You just have to watch it, but watch for it to stabilize, and that's probably a good time to at least pick. And I will say what I do is, when I start a position, I will start with a half of position size. Like, I know the size I want to get to eventually. I'll start with half, and then I kind of root for it to go down so that I can kind of, down 5%, I can buy a little more, down 5% more, we could buy a little bit more. So your dollar cost averaging on the down, not on the up.
Right. I heard you talk about that on a podcast recently around, it's a test of your conviction, to want to, again, root for something you've already bought, which is very counterintuitive, which, let's be frank, almost all of this business and much of life is. They keep telling me to slow my golf swing down and it'll go further. I struggle to believe them. How do you look at conviction and discipline, cheering for your stock to go down, within just stubbornness? And it's like, you're wrong.
Yeah, if the story has changed, if the reason that I bought it changed, that is something that I will cut and say, you know what, I got it wrong. I'm hoping for a 500 batting average. That will make me a hero. That would make anybody a hero. And that's what I kind of strive for. You're going to get some wrong and you're going to get a lot right. That's the ratio, more right than wrong. But it's really if the story, if the vision of the company, or if there's an abrupt change in the CEO or the management team, or there's just a change in the way they want to do business model change. Right. Those kinds of things are scary, because if a company is not doing well and then all of a sudden they change their strategy, that's not even a yellow flag, that's a red flag.
Fair. So unfortunately, we have to wrap up this week's segment. If there's one lesson, one thing you see investors who don't have your experience get wrong, or maybe just be unaware of, that would help them be a better investor, what would that one thing be?
Well, it would go back to invest what you know, but there's so much information out there from companies. I would say do your homework, work extra hard. It may not be so much fun, or maybe it will be, because you'll learn a lot of things. Management teams, if you listen to them consistently, and they do all kinds of investor conferences and that sort of thing, but if you listen to them over a couple of quarters over time, you will get to know the personalities. They will tell you a lot more than what they're telling you.
So one article in one magazine isn't sufficient.
Can't do it. No way.
Thank you again.
Thank you.
That'll be it for this week. Next week, we'll wrap up with Stephanie's thoughts on the economy. It'll be a few weeks from today, so we're not going to hold her to everything specifically. We'll keep it high level, but the economy, the markets, this is, we've talked about, relatively unusual time frame that we find ourselves in. Again, something you won't want to miss.